Welcome to Finantax Clips, your go-to source for all things finance. Today we're venturing into an often overlooked corner of the investment universe, the world of mortgage note investments. If you've been seeking a fresh, potentially rewarding approach to investing, you may just find your answer here. So what exactly are mortgage note investments? Simply put, when you invest in a mortgage note, you're essentially stepping into the shoes of a bank or other financial institution. You become the lender, holding the promissory note while a homeowner makes their monthly mortgage payments to you plus interest. It's a world where you're not just a passive investor, but an active participant in the financial ecosystem. Why are mortgage note investments relevant? Well, in a world of low interest rates and volatile markets, they can offer a steady stream of income, often with higher returns than traditional investments. They provide an opportunity to diversify your portfolio, and since they're backed by real estate, they offer a level of security that may be attractive to many investors. But, just like any other investment, mortgage notes come with their own set of risks and rewards. They require a level of financial savvy and due diligence that may not be necessary with more traditional investments. However, for those willing to do the work, the potential rewards can be substantial. As we delve deeper into this topic, we'll explore the intricacies of mortgage note investments, how they work, the benefits, the risks, and strategies for successful investing. We'll also provide practical steps to get you started on your mortgage note investing journey. Remember, knowledge is power in the world of finance. The more you understand about mortgage note investments, the better equipped you'll be to make informed decisions and potentially reap significant rewards. Now that we've introduced mortgage note investments, let's dive into the details of how you can start investing. To begin, it's crucial to understand what a mortgage note is. A mortgage note, often just referred to as a note, is a legal document that binds a borrower to repay a loan at a stated interest rate during a specific period. It's essentially an IOU that details the loan amount, the interest rate, and the repayment schedule. Now, let's break down the components of a mortgage note. There are three main parts: the promissory note, the mortgage, and the loan servicing rights. The promissory note is the borrower's promise to repay the loan. The mortgage is the lender's security interest in the property, which gives them the right to foreclose if the borrower fails to make payments. The loan servicing rights are the rights to manage the loan, including collecting payments and handling any issues that may arise. It's important to note that a mortgage note is not the same as a mortgage. While they are related, they serve different functions. The mortgage is the document that pledges the property as security for the loan, whereas the mortgage note is the document that outlines the terms of the loan and the borrower's obligation to repay it. In the overall mortgage process, the mortgage note serves a crucial role. It's the contract that binds the borrower to the lender, and it outlines the terms of the loan. It's the document that makes the mortgage possible, as it sets out the borrower's promise to repay the loan. And here's something interesting. While most people think of banks when they think of mortgage lenders, there are actually a variety of entities that can hold a mortgage note. These include banks, private investors, and even individuals. In essence, a mortgage note is a contract between a borrower and a lender. It's a crucial component of the mortgage process, outlining the terms of the loan and the borrower's promise to repay it. It can be held by a variety of entities, including banks, private investors, and individuals. With this understanding of mortgage notes, we can now explore how to invest in them. Investing in mortgage notes can be an excellent way to diversify your portfolio. Let's delve into the steps on how to do this. First off, you need to find and purchase notes. This can be done through various channels such as banks, hedge funds, or real estate note brokers. You can also look into online platforms that specialize in selling mortgage notes. Remember, it's all about networking and building relationships in this business. Secondly, once you've found a note you're interested in, it's crucial to carry out due diligence. This involves scrutinizing the note's details, such as the borrower's credit history, the property's condition, and the loan-to-value ratio. This step is crucial to avoid any potential pitfalls down the line. Thirdly, you have to understand the terms of the note. This includes the interest rate, payment schedule, and whether it's a performing or non-performing note. A performing note means the borrower is making regular payments, while a non-performing note indicates the borrower is behind on payments. Each type comes with its own risks and rewards. Next, you'll need to purchase the note. This typically involves negotiating a price with the seller. It's important to remember that the price you pay for the note will directly affect your return on investment. After purchasing the note, it's time for managing your investment. This includes tracking payments, dealing with any issues that arise, and deciding when to sell the note. In some cases, you may need to work with a servicing company to manage these tasks. Lastly, remember that patience is key. Investing in mortgage notes is not a get-rich-quick scheme. It requires time, effort, and a good understanding of the market. But with the right approach, it can provide a steady stream of income and a chance to diversify your investment portfolio. Investing in mortgage notes may seem complicated at first, but with thorough research and due diligence, it can be a profitable venture. Stay tuned for the next scene, where we'll explore the benefits of mortgage note investments. Mortgage note investments offer several benefits that traditional investments may not provide. Now let's delve deeper into why these investments are seen as attractive by many investors. Firstly, returns. A key advantage of mortgage note investments is the potential for high returns. Unlike traditional investments such as stocks and bonds, which tend to offer modest returns, mortgage notes have the potential to yield significantly higher returns. This is because the interest rates on mortgage notes are typically higher than those of traditional investments. Next up, diversification. This is a principle that most savvy investors abide by. Diversification is the practice of spreading your investments across various asset classes to reduce risk. Mortgage notes provide a unique opportunity for diversification as they're a different kind of asset class. They're tied to real estate, but they're not exactly real estate. They're a form of debt, but they're not exactly like bonds. This unique nature of mortgage notes allows investors to diversify their portfolio in a way that's not possible with traditional investments. Another benefit is control. When you invest in mortgage notes, you have a lot more control over your investment compared to traditional investments. You can choose which notes to invest in, negotiate the terms of the deal, and even decide on the course of action if the borrower defaults. This level of control can be quite empowering and can lead to better investment decisions. Last but not least, mortgage notes provide a steady income stream. Unlike stocks that may or may not pay dividends, mortgage notes provide regular payments as borrowers repay their loans. This steady cash flow can be a great source of passive income and can help investors meet their financial goals. So, to sum it up, mortgage note investments provide high returns, offer unique opportunities for diversification, give you control over your investment, and provide a steady income stream. These benefits make mortgage note investments an attractive option for many investors. Like any investment, mortgage note investments come with their share of risks. Now don't let that scare you away. Every cloud has a silver lining, and in this scenario, the silver lining is that these risks can be managed and even turned into opportunities with the right strategies. First off, one of the main risks is default risk. This is the risk that the borrower will be unable to make their scheduled payments. This could be due to a variety of factors, such as job loss, health issues, or simply poor financial management. To mitigate this risk, it's essential to conduct thorough due diligence on the borrower's financial situation before investing. This could involve checking their credit history, employment status, and other relevant factors. Another risk is interest rate risk. This is the risk that interest rates will rise, thereby reducing the value of the mortgage note. While it's impossible to control interest rate movements, you can protect yourself by investing in mortgage notes with a fixed interest rate. This locks in the interest rate at the time of purchase, protecting you from future increases. Liquidity risk is also worth mentioning. This is the risk that you'll be unable to sell the mortgage note when you want to, perhaps due to a lack of buyers. To mitigate this risk, consider investing in mortgage notes that are easily tradable, such as those listed on a public exchange. Lastly, let's talk about legal risk. This is the risk that legal issues, such as contract disputes or changes in regulation, could impact your investment. To protect yourself, it's advisable to seek legal counsel before investing and to stay informed about relevant laws and regulations. In conclusion, while there are risks involved in mortgage note investments, they're certainly not insurmountable. By understanding these risks and implementing strategies to mitigate them, you can navigate the world of mortgage note investments with confidence and poise. By understanding and mitigating these risks, you can make more informed investment decisions. So let's keep our eyes open, our minds sharp, and our strategies smarter. The world of mortgage note investments awaits. Success in mortgage note investing often comes down to strategy. So let's dive into some of the most successful strategies that seasoned investors use to maximize their returns. First up, we have the strategy of investing in non-performing notes. Now you might be wondering, why would anyone invest in notes that aren't performing? The answer is simple: potential for high returns. When you buy a non-performing note, you're essentially buying a debt that's not being paid. But here's the kicker: you buy it for less than what's owed. This difference between the purchase price and the owed amount is where your potential profit comes from. If the debtor starts paying again, or if you can sell the property securing the note, you stand to make a pretty penny. Next, let's talk about using a note servicing company. Managing mortgage notes can be complex, especially if you have a large portfolio. This is where a note servicing company comes in handy. These companies handle all the administrative tasks associated with your mortgage notes, including collecting payments, managing escrow accounts, and handling late notices. By outsourcing these tasks, you can focus on the strategic aspects of your investment, such as finding new investment opportunities and managing risk. Another winning strategy is diversifying your portfolio. Like any other investment, it's important not to put all your eggs in one basket. By investing in a variety of notes, such as residential, commercial, and even land contracts, you can spread out your risk and increase your chances of success. Lastly, always do your due diligence. Before investing in any mortgage note, make sure you understand the property, the borrower, and the terms of the note. This can help you avoid potential pitfalls and make informed investment decisions. Remember, these strategies are not a guarantee of success, but they can certainly tilt the odds in your favor. With the right strategies, mortgage note investing can be a lucrative endeavor. So, buckle up and let's explore this exciting world of mortgage note investing together. Let's recap what we've learned about mortgage note investments. This fascinating world of finance opens up a whole new avenue for diversifying your investment portfolio. It's an area that's not as widely understood as traditional real estate investing, but it holds significant potential for high returns. We started off by introducing you to the concept of mortgage notes. These are essentially IOUs provided by borrowers to lenders, promising to pay back a loan with interest. Mortgage notes are secured by the underlying real estate property, which means that if the borrower defaults, the lender can take ownership of the property. We then delved into the process of investing in mortgage notes. This can be done directly through banks and other financial institutions, or indirectly through investment funds. The key here is due diligence. Thorough research and understanding of the property, the borrower, and the terms of the mortgage note are crucial. It's not a realm for hasty decisions, but for meticulous and well-informed choices. Next, we explored the benefits of mortgage note investments. These include the potential for high returns, especially in comparison to traditional real estate investments. You also have the unique advantage of being in the driver's seat, having control over the terms of the mortgage note. Plus, you're also secured by the underlying property, providing a safety net of sorts. However, like any investment, mortgage note investing is not without its risks. We discussed some of these, including the risk of default by the borrower and the potential for loss if the real estate market takes a downturn. But we also shared some strategies for mitigating these risks, such as diversifying your investment portfolio and ensuring you have a thorough understanding of both the borrower's financial situation and the local real estate market. Finally, we shared some successful mortgage note investing strategies. These included buying non-performing notes at a discount, which can provide opportunities for significant returns if you're able to turn the situation around. We also talked about the importance of building relationships in the industry and the benefits of working with a mentor or joining an investment group. In conclusion, mortgage note investing is a complex yet rewarding area of finance. It provides an interesting alternative to traditional real estate investing, with its own unique benefits and risks. As with any investment, success in mortgage note investing requires knowledge, diligence, and a well-thought-out strategy. Thank you for tuning in to Finantax Clips. Please subscribe, share, and like our content if you found it valuable. Until next time, may your investments be profitable.